Like, do you see the secondary market in venture getting to be 50-50
Dude,
LPGP?
well, no, but that's why we started this business. Cause like
Yeah.
I couldn't understand when I was trying to sell fractional, piece of my carry in my first two funds. And again, one fund had Canva, the other one was already carry. I thought, hey, I'm gonna have an easy time. I had, arguably 30, 40, 50 million in value on the table. I just wanted like 3 million to like be able to buy a house in Silicon Valley. Nobody
Yeah.
would talk to me if I didn't sell at least five, right? Like,
Uh,
and there weren't like that many people for me to talk to. Like I talked to industry, I talked to a couple of friends at 137. Like it was a very small universe of buyers for fund secondary. In this case, I was selling carry, not even, LP secondary for good quality funds, with good names. It was still challenging. And this is, 4 or 5 years ago when it was a great market. It's even
yeah.
tougher now. But I think there's a ton of people who need the service, which is why you're seeing secondary capital explode and expand
Mm.
in size. Like after every crash, you see an expansion in secondary market capital. And, again, I don't know what the number is, but again, there's $3 trillion in liquid assets. Probably 1 trillion of that is garbage. Probably
Mm.
1 trillion of that it shouldn't be sold and should be held on to, but there's another trillion in there got some value. It should
Mm.
just be moved to a different set of investors with a different risk profile and time horizon.
Let's end on
But there's
this.
not a
Yeah.
trillion dollars worth of secondary
Yeah.
capital out there.
Let's end on this. The game on the field continues to change in terms of the amount of resources it takes a founder or a founding team to get to, let's call it 50K a month in revenue. We're seeing people come to us with no capital raised, or maybe they came to our accelerator or one other accelerator, raised 125K, and now all of a sudden they've got a $500,000 a year run rate. It seems like these AI tools, building AI tools, quick way to get quick revenue. People like to sample them. People like to pay for them. They're obviously getting value, so there's something there. But in addition to it, the AI tools are making it really more efficient to run a startup. Startups are capital constrained. Therefore, if you're capital constrained, you're going to look for the cheapest, fastest, best way to do something, and that typically seems to be AI. What do we think about how efficiently, capital efficiently, these companies are being run? Now, of course, after you raise money and you raise a bunch of money, you're going to spend it, you're going to hire a bunch of people. But I'm talking in that year zero to year one sort of time frame where you're seeing people accomplish more with dramatically less. It reminds me a bit of when you took out having to stand up servers. I think Dave and Thomas, we're
Yeah,
old enough to
it's
know.
the
Remember
same
that?
effect.
Yeah, it seems like a similar effect. What are your thoughts, Dave, and then Thomas?
Well, I've talked to a bunch of people about this who are starting to think about like, do you have to change term sheets now? Because I mean, I think as a founder, the pendulum has swung dramatically in your direction. Like you can raise at very high valuations. You don't need a lot of money to build companies. And theoretically now, you should be able to generate substantial revenue, maybe even substantial profit. Do you need to even raise later stage capital? Like maybe you're one and done, or you raise a pre-seed round from angels $1 million. You made raised a seed round. I hate to say this now, a seed round is like 5 to 10 million, but you
Yeah, the
raise a five
classic
million
seed
dollar
round.
seed
Yeah,
round,
yeah.
and all of a sudden you've got a company that's generating $3 million in revenue a year with growth and profitability, and your team is like 10 people.